Hi, welcome back to Academic Market Insights. I'm Dr. Russell Rhodes. This is Dr. Larissa Adamiec. This is part 8 of our series on personal finance and possibly one of the most important videos with respect to this is an 8. Come on, get it straight. 8. Well, that's a hand signal 8. All right, this is
Whoop,
number 8.
there we go.
Okay, that's close enough. So we're going to talk about individual retirement accounts in part 8 here, and IRAs. It's an opportunity for people to manage your taxes, avoid some taxes, and save money for retirement. And I will be completely honest. I wish I had. I mean, there are a few years where money was tight in the Rhodes household. I really wish I had made all the maximum contributions to IRAs that I could have over my lifetime. I'd probably be in a little bit better shape than I am right now. So with that, I'm going to hand things off to Dr. Adamiec. She's going to run through individual retirement accounts, and I will chime in as needed.
It's funny you should say that about maximizing your IRA, particularly when you think about defined contribution. One of the things that have come up quite a bit in with my undergraduate students is they're very concerned about the cost of living, their salary, and then being able to even save for retirement. So this is when you're graduating from undergrad and you're looking to get that first job, take it as an opportunity to really think about how much money you need to
Hmm.
live.
Hmm.
Um, because if you're in a situation where you're not going to be able to meet your payments, then yes, obviously you are going to be in a situation where you will not be able to maximize your contribution.
Hmm.
However, if you put that money away first, and you're not in that situation, let's say you're just not in a situation, you start putting away that money first, and then you have your disposable or discretionary income. It's huge because
Hmm.
once you get comfortable with that cash flow coming out, you don't think twice about it.
No,
It's a weird
it's one
phenomenon.
of those, it's just, you know what you get on your after-tax paycheck over and over and over again.
You just,
And I mean, it's going, you're contributing to it, but it's a bit easier if it never makes it to your bank account in the paycheck.
right, absolutely. And it's funny, it's a very like bizarre story that I'm going to tell you. So back in 2007, I bought my dad a Corvette.
Hmm.
And I remember lamenting about it because it was a 5-year loan, because it was a car loan, but it was a little bit more pricey than, let's say,
Hmm.
the car I'm driving today. And I remember speaking to somebody about it, and they said, well, once you get used to the automatic payment going out, you won't think twice about it. And I thought,
Right.
oh, how could that be true? 2 months in, never thought about it again. It's one of those,
Yeah.
if you can get into the habit, do it. And again, obviously some life circumstances dictate that that can't happen, and that's okay.
Hmm.
Nobody's criticizing. We're all warm and fuzzy people here to try to help you make the best decisions. But if you have that opportunity to do it up front, it's worthwhile. So again, we're looking at individual retirement accounts, and we're going to be talking about traditional versus Roth IRAs. So interesting things here. We have some limits for how much we can invest in each of these. And $7,000, I thought, wow, that doesn't seem like a lot. And one of the things that we talked about, and I don't think we talk about this in here, so I'm going to draw a little, oops, we can leave it here, but um, where is our
Laser pointer's not
laser?
working today.
Oh, okay.
Sorry.
So I'm going to have to pretend to draw like this. So one of the things that's really valuable when you're young is when you have compounding interest, your returns will look something like this.
Hmm.
Without that, if you start later, your returns will be up like this, still upward and sloping. Your the slope won't be as great in the
Hmm.
long run because you don't have that time on your side. So $7,000 initially, you might think that's not nearly enough because $7,000, I won't be able to live off of $7,000 for the year. Absolutely. But the objective is that you've got 40 years of compounding returns on this, right?
I'm going to do $7,000. I grab my
Calculator.
grab my HP. So present value, let's say 40 years, and let's say you make 7%.
I was going to go with 11%.
I'm going with 7%. That's $100,000.
So 1 year's worth of savings at
Yeah,
7,000 at the end of that's great. I like this.
that's just a 7% return. So that,
7%.
yeah,
Oh,
and there's this funny rule of seven or something where if you or 72, if you divide the rate you're getting into 72, your money about doubles that number of years. So if you're making 7%, you divide that into 72, that's nine. That means your account would double every 9 years. If your couple accounts doubling every 9 years, that gets you to, where we were at there,
right.
to the 100,000 bucks.
And 100,000, if you do that every year, think about that, and you're collecting all those $100,000,
Yeah.
and you end up with $100,000 to utilize in retirement. That's a great opportunity for you, especially given that it's $7,000.
It's a wonderful peace of mind.
Mm-hmm. Traditional IRAs, you can hold a variety of investments. There are lots of custodians, Fidelity, Schwab, JP Morgan, I believe, is a custodian. You can also get annuity or insurance through these things. This will come from your earned income. Any alimony can be invested into this, which is interesting because alimony is on its way out. And this is alimony is referred to as spousal support, similar to custodial support.
Mhm.
Uh, Taxable fellowship and stipend, that's going to be utilized much more if you are a student, and those monies can then be put away. So things that can't go into here
Huh.
is earnings from property, capital gains, unemployment, and Social Security benefits. And I thought that was interesting. And unemployment really is not that much money that you're going to be receiving. It's hopefully just enough to get you over the hump so that you can move forward with your life.
Mhm.
I think the Social Security benefits goes into the idea that if you're collecting Social Security, you shouldn't be investing into
Exactly.
an
And and
IRA.
and I was thinking when I saw the Social Security, I wasn't thinking of the traditional Social Security recipients that most people think of, which are people that have reached retirement. But there are other classifications of folks that may receive Social Security due to disabilities, et cetera. And if you're receiving Social Security, that really should be in those cases, it should be covering your living expenses and shouldn't be like some sort of supplemental income
Right.
that you need or don't need and maybe can put into an IRA. So I could see that one. That one I had to think about it for a second, but luckily it was at the bottom of the list and I could be articulate about it.
Yes. Interesting. Um, Active spouse. So you need to have at least one spouse adjustable or active into this. And there's just limitations for how much that you can start to contribute. And a joint salary of both would be $246,000. Calculation of IRA deduction is your contribution limit versus your AIG minus the lower limit divided by $10,000. What I wanted to talk about, and I think we'll get to a slide a little bit later, with some of the differences between traditional and the Roth, because the taxation of it's so important. But our participant status. So obviously somebody who's a part of a qualified plan, and there are certain government plans that allow you to participate in this. There's incentives for employees to participate. So Dr. Rowe brought up a great point about getting involved with this as soon as possible. But what we didn't talk about is in most of these plans, your company will match a percentage of your income for this. So not only are you getting that huge benefit of savings for maybe 40 years, but
Hmm.
you're also going to get additional compensation in the terms of matching. So there's a high reward for participating in this. Okay. Minimum rate distributions that
Hmm.
if you're at 72, you must start
Yeah.
distributing, which 72 might for some of you sound very old, but for some of us closer to 72, it sounds so young. Like,
Yeah.
what do you
I'm
mean?
getting there.
Yeah, I like this rule.
Yeah.
But the objective is that this is not something you can then hold on to. The objective in your IRA is to spend the money.
Yeah.
And you could be in situations where you have excess money and that goes into your account, and that's fine. But this isn't looking at that you can continue to reap the tax benefits of an IRA. So, exceptions to the 10% early withdrawal penalty. If you die, you do not have to deal with the 10%, the withdrawal penalty.
I appreciate that.
Terminal
Yeah.
illness, births or adoptions, medical expenses that are substantial. So these are all, and
Hmm.
disabilities. So these are all different things. And then rollover. We should pick on rollover for just a second. So a rollover will occur if you are changing from job to job, and the assets will roll over from one IRA to another. So if your employer, let's say, uses Fidelity and your next employer uses Charles Schwab, those assets hopefully will roll over. The advantage to doing a rollover is that you're not looking at two, but you're looking at just one account statement
Hmm.
every year. You don't, some people are comfortable with looking at multiple and comfortable with multiple accounts. Most people would just prefer to have one. Okay, other ones, qualified domestic relations order.
Oh, so if I get fired, I can dip into my cool
Which one was you looking at?
attainment of age 50.
Sufficient.
I'm in separation from service.
Mm-hmm.
No.
Woo. Dividend pass-through for your ESOP and distributions from pension-lined emergency saving accounts. Okay, so lots of possibilities, but they are very special situations.
And we talked about documentation in other videos. You're going to want to document if you have to do something like that.
Lots of
Just,
documentation.
yeah, you don't want the tax man to say, nope, you didn't do it right.
Right. And with the tax man, let's also be very clear, they're not your enemy.
Nope.
They are just looking to do their job and follow the rules. So if you give them everything that they need, they will be happy to
Oh,
do
yeah.
it. There's other incentives for to be able to utilize. I want to say it was Obama who did the first home purchase, and that's up to $10,000.
Hmm.
Um, And I'm glad about the payment of health insurance for unemployed because situations happen where you need to be able to pay those health insurance premiums.
Hmm.
For example, we both have children. We can't not have health insurance for the children.
Nope. Most people have pictures of their kids on their desk for why I work. I have a picture of our health insurance policy.
It's that critical.
It's important. It's
It's
very important.
really
That's,
important,
yeah.
especially if you have kids.
Yeah.
So this is what I really wanted to get to.
Mm.
Um, the taxation. In a traditional IRA, you are going to be using pre-tax dollars. So the advantage to that when we talk about the cumulative returns, and Dr. Rowe was very kind to give us the
Mhm.
$7,000 compared to 103. Would you mind redoing that and say $7,000 minus 30%, say 30% taxes,
So 4,900.
4,900, and then look at the 7% returns for 40 years and see what kind of a difference that'll make.
Oop.
It's thinking.
Well, it's because I hit the wrong button.
Okay. So it will be substantially lower because we started out at 4,900 as opposed to 7,000.
Exactly.
And that implication, it's going to be a very large implication,
73,000. So a
73,
difference of about $30,000.
which is pretty substantial.
Yeah.
Um, Now the conversely, in a Roth IRA, you could use post-tax dollars at 4,900, right? But then when you go to take the money out at distribution, you're not paying taxes on it. Versus in the traditional, you start at a higher point, and then so your cumulative returns will be higher, but you're going to have to pay those taxes at the end. And depending on your personal circumstance, your tax rate could be substantially higher than you are when you're younger. So I picked on 30%. Most likely, if you are just graduating from college, you are not in the 30% tax rate. I want to say probably around 22%. So it
Mhm.
will have an impact, and that's something to be aware of. Still worthwhile to maximize your retirement savings. Um, I think that in your traditional Roth versus your Roth or traditional versus Roth, your investment choices. So both of these say, yes, there are choices. I think in your traditional IRA is your choices are more limited because these are
Mhm.
going to be usually through your employer and they're going to be heavily revolving around mutual funds. You've heard me wax and wane about mutual funds,
Yep.
not the biggest fan versus in your Roth IRA, you're going to have a little more flexibility and you're not necessarily limited to just those mutual funds. So I feel like those are the important differences between the two different accounts.
Mhm.
Backdoor Roth contributions. So you can contribute to a non-deductible traditional IRA, and then step two, convert the traditional IRA to a Roth IRA. Ooh. And this is well known, so we're, using
Mhm.
saying backdoor techniques for this, but it is legal and well established.
And been done by at least one person on camera.
Okay, great. Just
Yeah.
one. So non-qualified distributions, they could come from earnings, uh, conversion contributions, and then regular contributions. Non-qualified Roth IRA distributions. Contributions, they're no subject to taxation and no 10% penalty. Conversions, no subject to taxation. Could be have a penalty if it's within 5 years of starting. And then earnings, yes and yes. And when we think about these issues, we're really thinking about the earnings. We're not really thinking about the contributions or conversions. Other IRA issues, investments, and then we talked about the limitation for how many different types of investments that we can invest in.
Mhm.
And, as investment people, that sometimes bothers us.
Oh yeah.
Like,
Yeah. Yeah.
yeah,
I've not gone to work anywhere that doesn't have a nice, wide variety of investment opportunities for your retirement or had an IRA where it's been very limited, but I do know those things exist. They're probably happy that I haven't worked there if they exist there because I would be pushing on them really hard. And you said in an earlier video that that's something that you should do when you're working at a firm. If you're not happy with the alternatives that are being given to you, retirement wise, say something about it. They want to make you happy. It's
they
much
do.
easier to keep an employee than find a new one that's worthwhile.
Well, and so I'll pick on my dad. My dad worked for a company called Air Products,
Hmm.
and he had stock bonuses. And Air Products for a while was doing very well.
Yeah.
And so what I started pushing for him to do was to start selling covered calls. He had a glut of this stock,
Hmm.
and it was all it showed up in his IRA. And he called up the his manager or the IRA manager and said, "I'd like to do this." And I don't think he really knew what he was talking about, but he could have.
Yeah.
We explained it, we talked about it. And then the person said back to him, "We can't do this in this account." And it was like this, oh,
Oh,
mhm, wah,
it's too
wah,
bad.
wah,
Yeah.
right? And if you haven't seen our video on covered calls or first investments in options, we highly recommend this video. Take a take a look at it. But these are some of the issues that you're going to see in your IRAs. It is not a free-for-all to be able to invest in anything else.
Ooh,
Yeah. I also thought alcoholic
wine,
beverages, right? But
wine.
like
Yeah,
you got to think my collection of wine from Costco, is that
not going up in value. The only
it's
thing you can buy from Costco that might go up in value is the middle one.
it's
Remember they were selling gold bars for a
oh
while. Yeah.
yeah, yeah,
I'm actually on my list of things to do. Dig into that one.
yeah.
Has that worked or not? Because I know gold's gone crazy. But you go.
Oh, I actually have a comment about that.
Uh-huh.
The challenge with buying gold or silver from Costco is that it sells out. As soon as it comes out to the market, it sells out.
Hmm.
So, and you got to think people who are buying it are also getting that 2% back. Or if you're using the credit card,
Oh yeah.
4% back. So
Yeah.
it sells as soon as it's put on the market, it sells immediately.
Hmm.
I mean, right? I mean,
Which has got to mean that there's some sort of profit there. I
yes.
bought, yeah. So
Even, I mean, because I think
yeah.
they sell it at the spot price.
Okay.
Yeah. Okay. We're talking about just the different qualified plans in your IRA, tax treatments, whether or not you can take loans out against it, how you protect those assets. Uh, this isn't for this video, but there are specific ways that we protect those assets by the company has to have purchase things like long puts, which I thought was great,
Hmm.
so that there is downside protection. Um, and in our qualified plans, you don't have investment control versus in your IRA.
Hmm.
And again, this is a soapbox issue for me. The government says that you do have control in your investments, but if your choices are very limited in scope, questionable how much choice that you do
Hmm.
have. So these are some of the differences. Again, we have prohibitive transactions. And really, it's the idea is the reason why these are set up is so that you really truly do save for retirement.
Hmm.
So you're not supposed to be borrowing against it. You're not supposed to be utilizing it now. You're supposed to be waiting until that distribution period. And then you're supposed to be able to utilize it. So again, anytime you're looking at borrowing against it or trying to take those disbursements, those are going to be prohibitive transactions. Uh,
And again, before you close out, that's just understandable.
right.
The purpose is an, individual retirement account to help fund your retirement. So, I think the restrictions are very justified.
Mhm.
Plus, people in the financial industry, much like the Costco arbitrage that you just talked about, are always looking for a way to work the system a bit. And I do know that there are some Roth IRA situations where people really aren't using the Roth IRA structure for retirement. They're using it for tax management purposes. So,
Absolutely.
prohibiting these transactions, it sounds like they're being very restrictive. No, it's just to make sure you're doing what you're supposed to be doing with these funds.
And I appreciate that you brought up how many people are trying to game the system at all times.
Oh yeah.
Yeah. And it's just part of human nature. And by being successful at gaming the such environment, you're
Mhm.
coming out ahead.
Yep.
So totally worth it. And if you like this video, please hit like. And if you haven't already, please subscribe. Thank you.